If you're a young adult and you're new to investing, you're gonna wanna watch this video.
I'm Alex.
And I'm Philip.
And we teach you what you need to know about being a grown-up.
Because adulting shouldn't suck. We're here in Orlando, Florida at FinCon, and we have the brothers Taylor and Brett here with LifeGoal Investments, and we're gonna ask them some questions about getting started with investing. So, yeah.
Tell us about yourselves.
Yeah, so thanks so much for having us. We enjoy you guys' channel and learning from you guys a lot. We came from the background of the Wall Street side of things. So he and I worked on Wall Street. I was there for a decade, him a little more than that because he's old. And what we did is essentially we ran around the country and worked with the biggest financial advisors.
Okay.
And chatted with them about their clients that may have $20 or $30 million. And I know this doesn't pertain to our audience, but we'll get there.
Yeah.
But at the end of the day, we looked under the hood of a lot of different investment portfolios. And what our takeaway was really they don't look very different. They all have some combination of the underlying assets, stocks, bonds, and commodities. And so we looked at ourselves and said, listen, we grew up in a one red light town. We grew up in blue collar as much as we were anybody else. And we said, who's helping those people out? And we said, we know what we can do. We can launch a product that will trade for $10 a share on Robinhood, Schwab, platform, whatever it is, and have all that stuff that's those ultra wealthy invest in, but available to anybody that has $10 a share to start to invest.
That's great.
So that was the motto and why we built out LifeGoal Investments. So that's where we're here.
Sweet.
So most of the people on our channel are 18, 24 years old. And what investing advice would you give to someone who's just getting started with their investment journey?
Sure. You want to fire away at that?
Yeah, I'll take it. Taylor happens to be a certified financial planner, so it's probably better suited for him, but I think I can handle it too.
Okay.
I've got a little background in this business. I would say that you'll want to get started early, but start slow, right? I know that there's a lot of flashy investment products out there, crypto, ETFs now that are triple levered, things that can really shoot the lights out, but they can also really, really hurt you. So you want to get started to get your experience and to get it under your belt because it's a very emotional journey.
Yeah.
That when you're just starting when you're younger, you don't have a lot of money. So a slip up is not a big deal because you didn't lose a lot, right? And you'll get more and more consistent in your ability to, you're not timing the market or anything, but your ability to know how investing jives with living your life, right? So not all the investment that we talk about is retirement money where you put it in and it sits there from age 24 to 65 when you retire. There's investing that you have that you need to access to buy your home, buy your car, get married, have a baby, that as well. And you want to get started early, you want to start conservatively, and just realize that things are going to change in your life. And when things change in your life, your investment time horizon changes, and therefore you need to understand kind of how that that yin and yang works. So that would be kind of the advice that I have: is get started early. And stay relatively defensive in your investing nature.
Nice.
Get your goals written down. Like get what you're trying to do to begin with and get it set aside and write it down. And the reason you write it down is because you can constantly go back to it and say, okay, do I need to modify the goal, or am I doing things that aren't leading me to the goal that I really need to be, which is the stated one on the piece of paper. And then I think the other thing is like, understand your gut is actually not necessarily always a bad thing to follow. So when something looks too good to be true, it might be. And not crypto is not bad, good, anything indifferent. But if you can't explain to me what's going on in crypto, should you be investing in it? I don't know. And I think it's a tough explanation for most people that are investing there. So if you can't explain why you're buying something and what it's going to do for you in the long run, you probably should question your gut and say, is that something I belong in?
I'll throw something pretty nerdy in if you're done. So, in the movie Fast and the Furious, they say, I live my life a quarter mile at a time. That's pretty cool, right?
Yeah.
I don't do that. I live my life in an Excel file. And it's very easy to put your financial life in an Excel file, right? You got 12 columns, the months of the year. You put your number over, you decide where you want to be, how much money you're making, and you can leave it in an Excel file, save it on your computer, and then go back to it and say, okay, my employer just gave me a raise, $1,000, whatever it is. Go back, adjust the numbers, and you have it in an Excel file. It's very easy to see what trickles to the bottom, which would be your free cash flow after you pay all your bills, your rent, and all that. So you have that much extra set aside. Okay, what percent of that do I want to spend on having fun with my buddies? What percent of that do I want to invest? What percent do I want to do with it? It's just very easy, very clean, and very easy to go back and adjust. But if you live your life in an Excel file, not a quarter mile at a time, it'll really help you stay on track, and it'll make your life a lot easier on the investment front.
Awesome.
From Vin Diesel.
That's really good advice, because in my early 20s, I was definitely quarter mile at a time. And I didn't have a lot of money left over.
Yeah.
There you go.
So, actually, not a question that we had originally thought of for you guys, but how would somebody in that age group, you know, the 18 to 24, let's say they don't have those goals set, they don't know where they want to be, how would they go about maybe setting some goals or just some quarter mile goals to get them started to help them kind of move to a bigger goal in the future?
Yeah, I think that's all a game of looking at your life and saying, okay, where am I at right now? So what am I doing on a day-to-day basis right now? And then thinking realistically, what does 5 years out look like? And you might not know, but you can set some expectations that things are going to progress towards this direction. Maybe I find someone that I want to settle down with. And what are some expenses that come along with that? And then do a little research and sit down and say, okay, average wedding, if you think you're going to get married, costs $10,000, $20,000, whatever the number is. And then just start to chip away little bit at little bit. You don't have to start huge. You don't have to massively change your life. You're not going to. If you massively change something, you're going to work. It's like dieting. Dieting for a month. You lost 15 pounds in a month. That's not sustainable. You know, start slow, just eat healthy, get a little bit more exercise in. And that's how you do it from a budgeting and a goals-based perspective as well. Don't start out with these massive goals that are unattainable. You sit at home and twiddle your thumbs because you can't spend any money doing anything. That's not reality.
Yeah.
So live your normal life, but maybe eat out once less a week. Whatever it is, like take that little chip and put it away. And then what you do is you figure out what the goals are, and that money should not, over time, sit in a bank account. You need to have enough set aside in your bank account to live for 3 to 6 months, whatever it may be. But beyond that, then that's when you start to invest it, because we all know inflation is rampant in the United States right now. 9.1%, 8.5, it came down. 8.5%. So if you're sitting in a bank account yielding 0.02, you're losing 8.5% purchasing power every single year. You're negative 8.5% what your money's going to do for you next year.
Yeah.
So that money needs to be invested. It's not to say you need to buy crypto or high-flying stocks. You can find things that are more conservative to do what you want to do over time, but you got to set your goals, chip away at them slowly. Don't do everything overnight.
Oh, yeah. Awesome. So, why do you guys think that ETFs are so popular right now?
Sure. ETFs are the easiest way to access a diversified portfolio, okay? So you could go out and you could buy Amazon, Apple, Microsoft, Ford, you know, the stocks that you like, and that's 4 or 5 stocks, right? And they may or may not do great in the future, but if you buy an ETF, you get thousands of underlying holdings, right? And our ETFs at LifeGoal Investments, actually, you don't just get stocks. You get stocks, you get bonds, which typically do well in a recession. They did very well in 2008, for example. You get commodities, like gold and oil, and then you also get real estate as well. So you get all 4 of those things in one ETF at $10 a share. So it really brings diversification from not just at the stock level, not just 500 stocks like the S&P 500 or 1,000 stocks like some other ETF. You get thousands of stocks, thousands of bonds, commodities, and real estate in there. What that does is it creates a more predictable investment experience, right? And when you're 18, you know, I was 18 at one time, right? And I made a lot of mistakes, just like everybody else here, and everybody else that will be viewing this will definitely make mistakes as well. But one thing that is absolutely certain is there's going to be a lot of change in your life, right? You can't predict the future. So you can't predict the future, therefore you need to have a predictable investment so that when something changes, and you go to grab that money to buy a new car or whatever it may be, that the money's there. And it's not down 30%, it's down at worst, 7 or 8. And that's why we built our ETFs the way that we built them. Frankly, we got asked the entire time we were working on Wall Street, working for the ultra wealthy, for our buddies from our hometown, the guys we played football with, the guys we played basketball with, like, what should we be investing in? And we never had a good answer because the answer was so complex that they weren't interested in it, right? Nor did they have the financial means to execute on what we would have given them. So we built exactly what we essentially did for the ultra wealthy, put it at $10 a share, put it with a name and a ticker symbol that could be easily digested. And that's something that especially young people, they don't have $500 to put in every month. They may only have 50. So if we're at $10 a share, that gets you 5 shares. You're getting started, right? That's the name of the game. You got to get started. So I would say that's why LifeGoal Investments is so popular, and our ETFs are really being accepted widely.
The reality is, when you look at the S&P 500, which is the broad-based stock market, over the past 20 years, it's averaged 7.5% rate of return per year. The bond market, which is boring stuff, old people buy bonds, that's averaged 4.8% per year over the past 20 years. The average investor, so 7.5, 4.8. The average investor, those are basically the two things you can invest in, has averaged 2.9%. 7.5, 4.8, 2.9. How does that happen mathematically? How does that happen? And the only answer to how that happens is people probably take on too much risk. They buy at highs. Things feel good at highs. The market, the economy's humming, everyone's talking about how much money I made, etc. People buy then, and then that's when things start to roll over and they go down, and then when it's at its worst point, no one's got a job and it's scary as all heck. And they sell out, and that's how the progression works. And that's how from 7.5% per year on stocks, 4.8% on bonds, 2.9%. So what we said was like, let's just take that massive downturn out of it and truncate the bouncingness of the market. And that's why you build an ETF like we did, to just make it easy on folks.
Nice. So another question, just kind of leading off that one, is when you hear that the average over the last 40 years of the stock market is roughly 10%,
Yep.
Where does that number get inflated from based on, ETFs and bonds?
So reiterate your question, if you would, because I'm not sure.
So what's the difference in the rate of return for the bonds and the ETFs versus, I think, like Forbes or Investopedia or whoever else typically quotes that like over the last 40, 50 years, the average rate of return for
Gotcha.
the overall is 10%.
Yep. Yeah. So if you look further back, so the last 20 years have experienced two tough times. Experienced the early 2000s, 2000, 2001, 2002 was a tough 3-year market. And then obviously you also have the 2008 great financial crisis, and then 2020 where there's a drawdown as well. So if you broaden the spectrum out further, the 80s and 90s were a pretty good run on the market. So the returns on those numbers look higher at 10% versus that more truncated period of the last 20 years where it's 7.5%. But also what happens is the worse the market does, the more bad periods there are, commensurately, the average investor does even worse than they do in the good times because they sell out at the bottom, right? So if the market's doing choppiness and doing badly, the average investor might return 7% less. In a good market, they probably return 5% less because they don't get washed out on the bottom as much.
So I'll jump in on it as well. So let's say you go back 100 years. Stock market on average, to your point, has done about 10% per year, right? So there's something out there, you probably heard it in your math classes, called reversion to the mean, right? So reversion to the mean. I'll use my golf game as an example. My golf game it's missing in action, right? It's on a milk carton, right? It's missing. So my golf game, if I have 2 pars in a row, you can bet your bottom dollar that I've got a double bogey coming up, right? So I'm doing well. I have par, birdie. Reversion to the mean, I'm not that good of a golfer. So I know that it's going to happen, that I'm going to have a couple really bad holes. So if we look at the stock market over the last 10 years, outside of just the crash that happened this year, it was doing 13, 14, and 15% per year. The long-term average we talked about is 10, all right? So if you're doing 13, 14, 15, if you got to get back to that long-term average of 10, you got to do a few bogeys, right? You got to have a few years where you're either having a massive down year or you do 4, 5, and 6 several years in a row, right? So one can look at where the market is, and there's a bunch of different ways of doing this, much like my golf game. If you see I'm doing well, you know that I'm about to hit one in the woods because of that reversion to the mean. And you can say, all right, well, if I think the stock market over the next few years here is going to average 6%, okay, what else can I find out there that can get me 6% with less volatility in stocks, right? So that's where bonds come into the picture, or potentially other ETFs that have a risk profile. Maybe they yield 6, right? Right now you could buy high yield debt, which is about half the volatility of stocks, that actually yield about 8. So you start looking at these different asset classes and you say, well, maybe I can make a jumbo or a soup or a cocktail, if you will. A gumbo, right? So it is Friday morning here at a conference. Maybe I can make a cocktail that's more diversified than just stocks, that has a very comparable return profile for the given outlook, considering we know that reversion to the mean has to happen. And then when you really get stocks to sell off, we'll look to sell some of those things and get into stocks on the low. So that's how you run an active portfolio. That's exactly how we run things in-house at LifeGoal. And
I was gonna say that's what you guys do, right? You just simplify that whole process.
yeah, we
So you
look to
take all the
simplify,
complexity out of it, and then they just buy your ETF, and then it's done.
Right, it's an easy button. You don't have to do this. You don't have to worry about the, reversion to the mean and different asset classes. Like, we built this so that you can focus on your enjoying your life, your career. Remember, the number one income earner in anybody's life is their job. It has nothing to do with their stock portfolio, right? So focus on your job. That's where you're going to make yourself rich or ultra rich, and leave the investing up to to somebody like us that's capable of focusing only on that.
The only thing I'll say to this, because I know the demographic we're talking to here is 18 to 24. Everyone's heard of a financial advisor. So if you have $1 million, you go to a financial advisor, they'll do all this for you.
Yeah.
But what about when you have $1,000? What about when you have $5,000? That's exactly what we built our product for. Do the same thing the financial advisor does, combining all those different things with all that education and background that they have, but do it in a way you can access for $10 a share.
So what kind of advice would you give to somebody who's in that 18 to 24-year-old bracket? They just started investing, and maybe now they just want to pull all their money out because they're scared or they're freaked out with what's going on in the stock market?
Yeah, there's no guarantees in the market, so you cannot say this. But the market has always gone up over time. So stick with it through the tough time is the biggest lesson to take away. But I think in hindsight, looking back, what you can look at is you've just experienced a tough time. Is that too much for your stomach to handle? If that's too much for your stomach to handle, you've probably taken on too much risk. And also look back at this and be thankful that you're early on in your investing career so the numbers aren't as big that you might be losing. And say to yourself, okay, when I bought that, whatever it was that I bought, did I have a reason for buying that? Back to the crypto conversation. Could I explain what crypto is to somebody, to my grandmother, in layman's terms? Can I explain to them what's going on with that, why that's going to be an income-producing asset for me down the line? If the answer is no, then you got to second guess why you made that decision and say, do I want to make that decision again in the future? And that's a really important thing to start to understand is why did I make decisions? Take it back to the goal list. Do my decisions align with the goals that I've placed? Did I get talked into something because of how good it looked at that given period of time, which is generally not the right thing to invest in, because when it looks really, really good and nothing can go wrong, that's when things roll over. So go back to those fundamental questions and say, okay, can I make a better plan? Can I have my investments align better with the goals that I have? And can I use my gut a little bit on the front end when determining what it is I'm buying to make sure I understand if this is a sustainable investment or if this is a fad that I can't explain?
Yeah, so right now, LifeGoal Investments has 3 ETFs. 2 of them, I think, are perfectly suited for the demographic that we're chatting with today, right? The 18 to 24-year-olds. The LifeGoal Conservative Wealth Builder, ticker SAVN, S-A-V-N.
Okay.
It's about 30% stocks, 60% bonds, 10% commodities. It yields 3%, and it's designed to create the most predictable investment experience. Right, even this year, it's having a really good performance year. But when you think about living your life in an Excel file, right, and wanting to execute on the things that are important to you that you put in that Excel file, right, you need something that's predictable. So we built this ticker SAVN, right, S-A-V-N. We built it exactly for this demographic. It's literally perfect for this demographic. And then the other big thing that's going to happen for 18 to 24-year-olds is they're, when they turn 30 approximately, it takes about 6.5 years, they're going to buy a home, right? At some point, they're going to pull the trigger and buy a home. And we built the first ever patent pending ETF designed to help somebody achieve a down payment for a home. So if we look at the United States, it's a very cool idea. We came up with it because
we had idea, so it's a cool idea.
Yeah, right. we came up with it because I had to buy a home. It's not hard to come up with an idea when you're tasked with a challenge and you need a solution. So when you think about it, it takes the average person 6.5 years to save for a home. And home prices actually went up 20% the last 2 years in a row. So now it's probably like 7.5. It's probably longer. So the savings account at the bank yields 0, right? And home price inflation in the United States, although the last 2 years were very high, right? We expect the reversion to mean to come back down. The long-term average is 5.5% on home price inflation. So we built HOM ETF, the LifeGoal Home Down Payment ETF, ticker HOME, to target about a 5.5% return per year. That keeps you directly in line with what you're trying to buy, and we want to do it with as little risk as possible because you may want to buy that house 2 years earlier than you initially thought, right?
Yeah.
Things change in life. So we were more conservative in the design of it than initially. But those ETFs are just so well suited for this, this group, this demographic. And I think whether it's they're talking to their family or they're talking to their friends, that home ETF, tell them, listen, I just set aside $500, start saving for my, for the purchase of a home at some point down the road. Ticker is HOM. You tell your parents that, they are going to pat you on the back. They're going to say, good for you, man. Way to be thinking ahead, right? If you want a tree to hang out under 10 years from now, you got to plant it today, right? You can't just show up and create that down payment for a home out of thin air. So, we think those two ETFs are really well suited for this group.
Yeah, no, I mean, it's
where
great.
that tree analogy was going, but you got to plan it now for 10 years down the road.
Yeah.
That's good.
Yep, yeah. Awesome. Okay, so what piece of advice would you give an 18-year-old that is just entering adulthood? Any type of advice, relative to finances.
Yep. I keep going back to this, and this is not when times get tough, start following your gut, because when times get tough, you follow your gut, it tells you to sell. But on the onset of investing, you have to follow your gut again, going back to, okay, let's write down the plan. Here's my goals. That's number one. That's the number one piece of advice. Write down your goals. Write them down, because when you write them down, you store them someplace you can go back to. You can constantly revert back and say, okay, are the goals the same? And it was what I'm doing right now logical to the goals that I have stated.
Yeah.
Because when you take time and sit down and write out your goals, it's a different mentality. You put yourself in this little box for an hour, get your stuff put together there. And then again, when it goes to the investing, you have to say to yourself, okay, I know what I know what I don't know. Be honest with yourself. You know what you don't know. And if you're not an investor, you have to simplify things. And then follow your gut. And your gut tells you to do things generally in a good manner on the onset of buying. And that's when you say, does this make sense for the goals that I have laid out? Can I logically explain why I'm buying what I'm buying? Is it going to help me hit these goals that I've written down? And if your gut tells you it's not, then you need to rethink the plan. Don't rethink the goals, because that shouldn't change. Rethink the investment plan and make sure that investment plan aligns again with what those goals are.
Yeah.
Follow your gut. Don't invest in things that don't make sense to you. If you can't explain to them, probably not a great investment.
I'll throw something a little bit out of left field here, slightly off topic,
I like
but
it.
I think it's really appropriate for the group. And I think this is not as investing focused, but three things. And the one is a real wild card. Don't drink and drive, right? Don't drink and drive, right? We're living our life in an Excel file. We're trying to navigate the personal challenges in life. We don't need more obstacles in the way. The second one, don't buy a home until you are, I would say at 30, somewhere 25 to 30, because what happens is life changes and you end up with a home somewhere that you're not actually going to live long term.
Yeah.
So a lot of people, we have a family member, I know 10 people in my close group of friends that have a home somewhere or a piece of property somewhere and now they're 3 hours away from there and they're in a weird spot trying to, they have this home and they're trying to afford the next one. So they get themselves in a pinch. So go slow, right? That year, when you become a 30-year-old, 27, 30, you're going to have a really good handle on life. From 18 to 24, you're going to have a lot of fun. And you're going to have a looser handle on life, right? And then lastly, when you're going to get married, right? Important decision in life, very important, especially when it comes to financials. I personally think, and this isn't for everybody, but I think that, around 30 years old is probably a really good time to make those big life decisions as well. Don't feel like you got to dive in at 23, 24, whatever it is, and pull the trigger because you're madly in love. Go slow. Go slow with life, man. You don't have to rush through these really big decisions, because these really big decisions are permanent. And when you get involved in something that's permanent, it can really change the future for you. So I would say those are a little bit off the cuff.
Yeah, they're good though.
But I think it goes back, if we want to bring it back to ETFs, one of the reasons why the ETF is so beautiful is because it's completely liquid. It's the exact opposite of marriage, buying a home, and getting yourself in trouble for doing something silly, is you could pull it out at any point. So the logic there is go slow, get some experience under your belt, and stay liquid.
I love it. Yeah. So kind of going back to your number two point of advice there, don't buy a home until later. So I bought a house when I was 20, and I was like, I'm doing it good. And then I only lived there for like 18 months, and then I had to figure out like, well, what do I do with this thing? Do I sell it? Do I rent it? What do I do, right? Because I ended up moving to the other side of the state, and it just created another hurdle of problems that I didn't think that I would be having at 22, 23. So yeah, if I would have waited, I could have done things a little bit differently. So yeah.
On the bright side, you got the house for cheap, though.
I did.
There you go.
I did.
Hope you flip that baby for a profit.
I did.
All right, so if people want to learn more about what it is you guys do or more about investing, how can they find you?
So we put out daily stuff on Instagram at LifeGoal Investments, and the purpose of it is not to talk about our product set. The purpose of it is to talk about big kind of macroeconomic things at LifeGoal Investments.
Perfect.
we talk about big things that go on the market, in the economy, and we talk about them in layman's terms. Boil them down to really simple things that you could talk to your grandmother about and she could understand it. So we take complex topics that they talk about on CNBC that no one understands because it's a foreign language, financial jargon. Like, we do understand that because we're nerds, and that's what we've been trained to understand. That's all of our education. And what we can do is also be humans, hopefully, and deliver that to folks like you guys and your followers in a way that they can understand and digest.
We appreciate it.
Yeah.
That didn't come off right.
Awesome. Well, this is our second time meeting you guys here at FinCon. We met you guys last year here, and these two they're great. They're genuine people. They're really out here to help, and we love chatting and interacting with them, and we loved having you guys here on our channel. But that pretty much wraps up our interview. So if you guys like this video, make sure you guys hit that like button. Don't forget to subscribe. In the comments below, let us know if you have any questions for the brothers.
You guys are the best. Thanks for having us.
Thank you.
Woo!